either feel free to yell out your questions or type them in the chat, and I'll endeavour to get to your questions. So if there's three things to remember from today, these are the three. One, to approach M&A cases like any other case, and that is to follow a structured process, right? Second point is to be clear on the deal thesis, and we'll go into that in a moment. And third but not least, and I think this is very important, always keep in the back of your mind, would you buy this company? So this is particularly important if you're doing due diligence type work. At any point, the client might ask you to put your pens down, and you need to be able to give the client an answer. You know, should we buy this company or not? And if the answer is yes, then how much should you buy them for? And what should you consider? So M&A is one of those, well, particularly due diligence, is one of those times that it's extremely stressful. Your timelines are very short. And timelines can change around all the time. So the timeline to submit a bid can be brought forward, it can be put back. Those timelines are very flexible. And particularly when you're dealing with private equity funds, they're also very idiosyncratic. So they can, on a whim, go, okay, just tell us what the answer is and be done with it. We don't want to spend any more money on consulting. Just give us the answer. And we don't, you know, the margin of error might be more like 25% versus, you know, you spend another 2 weeks burning consulting time, and that might get you to a 5% margin of error, but they don't want that level of precision. They just want an answer. Should we buy it or not? Any questions on that before we move on?
Here's a quick question, Terry, just on the practicalities of what consultants are doing in the M&A process. I mean, I'm a lawyer and I worked on some M&A processes on the legal side, but I've never really had a good insight. I haven't really worked with consultants involved in the team before. So just interested what, you know, on an M&A, typical M&A deal are consultants looking at.
Cool. So I'll get into that momentarily in a bit more depth. But in general, if you look along the life cycle, you could be involved pre-deal, so that's doing the growth strategy part. Should we be using M&A as a tool to achieve our growth targets, or should we be doing something organic, or should we be doing JVs or some other strategic thing, right? Some other strategic option. Then during the deal itself, there's a myriad of different types of due diligence that you can be doing. Plus, you got an eye towards the integration part of it. So once the deal is actually done, that's when the real work starts to integrate the asset, particularly if you're working for a strategic buyer. You know, how are you going to put the two together? And then there's kind of like a fourth part of the deal, the deal cycle, life cycle, which is the divestment. So sometimes if you're involved in the carve out or the spin off, particularly if you're working for a private equity fund, that's another part that you might be involved in. So we'll get into that a bit further.
And some of it, I guess, overlaps a bit with what an investment bank might do, or some transaction you might have an investment bank and not a consulting firm.
Absolutely, yeah. There's a bit of overlap. If anything, then investment banks probably a bit more involved on the financial side of things, but that's not to say they can't be involved on the strategic side of things as well.
Yeah.
Cool. Any other questions? All right, we might move on. So, stages of the deal life cycle, and I alluded to this a moment ago. So if we're looking at the pre-deal, like these are the typical sorts of activities that you as management consultants or consulting type candidates will be involved in, right? So as I mentioned, growth strategy, market scan. So what that means is you're looking for different assets through the market. And an investment bank probably is involved in this sort of thing as well. And you might do some preliminary diligence, some really high level stuff you haven't made an approach to the target. You're looking at whatever publicly available information there might be to try and determine, okay, is this a sensible target or not? And maybe come up with a short list. Stage 2 is the transaction itself, where you get into detailed due diligence. You'll do the integration planning, initial planning, and you'll do some synergies modeling. Now, depending on whether you've got access, how much access you have to the target will determine how detailed your synergies can be or how accurate your synergies can be. In this case, for the most part, it's going to be just initial and not detailed synergies modeling. Then if we get into post-merger, so the deal's closed, everyone's signed on the dotted line, there's been the transfer of funds, then you get into the post-merger integration, or in McKinsey, we used to call it merger management. So depending on who you're working for, you might hear the term post-merger integration or merger management. And at that point, you'll do a bit more detailed synergies modeling, come up with initiatives to drive the post-merger integration and realise the value from the deal. Then there's this fourth part, which some will refer to as a fourth part. You might see this stage of the deal life cycle. Some people refer to 3, some people refer to 4, which is the divestiture. This is mostly relevant to private equity funds or people that are serial acquirers that buy companies and spin them off later on. So as management consultants, you'll be involved probably in the portfolio, the corporate strategy, the vendor due diligence, which is the due diligence involved advising the seller, you know, what the value of that spin-off might be, and do a bit of separation planning. So any questions on this before we move on? I'll take that as a no.
Yeah, Terry.
Yep.
Naturally here you've highlighted quite a few points. Presumably in an interview we're expected to lightly touch on most of them, but not go into super depth into perhaps all of them?
During the interview, so during the case interview, you're probably going to be thrown a case around due diligence, right? That's going to be what I'd say is 99% of the time. If you're thrown an M&A type case, it'll be due diligence. The point of this exercise here, what I've just laid out, is you want to be thinking about all these things along the life cycle, and it flows on to my next point about the deal thesis, right? So there's 2 different types of buyer, and I'll pose a question to the group. What are the types of buyer? What are the 2 types of buyers do you think?
Terry, so with divesting, are we mainly looking at that because potentially you're buying and it's anti-competitive, therefore we have to divest, or you're looking beyond that as well, like just slimming down to be more focused on the portfolio?
Well, you could be. That's a really good question. It could be anti-competitive matters. So I'm just trying to think what's in the public domain. That's recent. So Asahi buying out CUB, right? I think they had to spin off. Was it might have been Heineken or something like that, and there were a couple other. I think there were some cider labels that had to spin out. So it could be forced by regulatory matters. If you're dealing with a private equity fund, more often than not, they'll be buying an asset and they'll hold on to the asset to do something with it over the next typically 3 to 5 years, and then they'll spin it out again. They'll sell it off again because the investors have to get their money back, right? They're not holding on to this asset for the next 10, 20 years. Like the private equity funds are not in the business of running businesses per se. They're in the business of generating returns for their investors. So that means they've got to realise their capital at the end. So
is it also freeing up capital, or that's usually not a concern? Like if something's older in the cycle and you're about to do another purchase from a context of private equity, Are they looking to free up capital too, or not really? They look for
Not necessarily. So it depends what they're trying to do with the fund. But normally funds have a finite life, right?
Yeah.
So if you can look at any private equity fund and they'll refer to it as, flagship fund number 1 or something like that. And you might see multiple funds. So they'll have flagship fund 1, flagship fund 2, flagship fund 3. And you'll see that flagship fund 1 might have closed in the early 2000s to new investors. Then they had a whole heap of assets within that fund. Then the fund was eventually paid off and all the assets sold off by maybe the early 2010s. Investors, and they're not using those funds to reinvest in something else. They'll raise a new fund to new investors, or maybe existing investors that want to turn over their funds and reinvest in that new fund. So that's what they're trying to do there. Clear? All right. So just getting back to this. So 2 types of buyers. There's strategic and financial. So strategic buyers, they're like companies within the industry itself. So as I mentioned, Asahi CUB. Asahi would have been a strategic buyer because they're buying the assets of another beer company. They're in the same market. They're not going anywhere else. Financial buyers, typically your private equity fund. So they're buying up an asset. They'll have some reason for buying that asset. Ultimately, they want to generate a return on their investment and provide that return on investment back to their investors at some point down the track. So why that's important to have that in mind. So if we go back to this point about the due diligence, and when you're approaching cases, having clear in your mind whether it's strategic or financial might determine what sort of analysis you're going to do in your due diligence case. All right. If they're a strategic buyer, well, yeah, let me pose this question to you. If they're a strategic buyer, what sort of analysis might you want to do? Or what might you not want to do?
I was thinking synergy might be what they want to do.
Yep, synergies, absolutely. I think you do that in both cases. Yep.
I'm just thinking maybe you don't have to worry about the exit component as much as you would be, in the financials. You might be looking at, or do you IPO later, or do you, sell to a strategic buyer? So maybe in the analysis, you don't need to focus on that as much.
To some extent, yes. Yep. Others?
Well, with a strategic purchase, you're also thinking about combining it with an existing business. Would that be consideration?
Yep.
So it might be cultural fit and stuff.
Definitely, and that's a really good one. That's a really good one. Thanks, Richard. I like that. So I think, look, it's a case-by-case basis, right? But in the case of a strategic buyer, so let's say, well, a client I'm working with at the moment is in the health and beauty industry, right? They know who their competitors are. They know what the competitive landscape is. They know at what rate the industry is growing, that sort of thing. So you're probably going to do less due diligence on the market itself. That becomes less important because they know that information already. What they want to know from you is what are operational aspects, all right? So this company we're looking at buying, this target company, like what are the assets? How are they operating? What's their level of profitability? How sustainable are their profits or their financials going in the future? How are we going to integrate this asset? To Richard's point about the culture, how are the people going to fit within our organisation? Are we going to work well together? Is there going to be a clash? Do I need to think about firing these executives, or are these people the sorts of people that we want to hang on to because they actually know something about the industry and they can add value to us? Those are the sorts of questions you want to be asking. If you're advising a financial investor, financial buyer, depending on how much that financial buyer might know about the industry, you might have to double down on, what's the market growth rate, who are the competitors, what's the general prospects of the industry. So another example, when I was at McKinsey, had to do a due diligence on a fast food chain. The private equity funds was Asia-based, right? They knew nothing about the Australian fast food market. So we had to do a lot of due diligence work on the state and the prospects of the fast food industry in Australia, right? That's not to say you ignore the operational side of things, but you had to focus more on that. So is that reasonably clear? Cool.
Terry, is it fair to say a large proportion of the financial buyers would be just PE?
For the most part, and so this raises an interesting question, right? So my question here is, where might a financial buyer look like a strategic buyer, or vice versa?
I would have thought PE would be financial and strategic would be like a major player in a certain industry.
Yep, I think that's true, David. Yep. Any other ideas?
Infrastructure.
Just delve in a little bit further, Nick.
I hadn't delved into too deeply, Terry. I guess I just think about some of the infrastructure funds, or even like super funds of that, where they're buying a lot of infrastructure. I mean, there's obviously a financial side to it, but they do have expertise in infrastructure as well that I imagine perhaps they would bring to bear once they've actually invested in that particular infrastructure. That was as deep as it got.
Yeah, that totally makes sense. I don't agree with you. In a general sense, what I was thinking here, a financial buyer might look like a strategic buyer if you're a PE fund where you're following a strategy that is platform-based. So what I mean by that is you buy a platform company and you do a series of bolt-ons. So let's say you're Bain Capital, right? You've just bought Virgin Australia. So initially you're a financial buyer, but let's say Bain Cap, their intention is to use Virgin Australia to hoover up all their competitors in the Australian market. So they're going to buy out Rex, they're going to buy out Compass. I'm just trying to think of who the other little players are in the industry, right? So let's say they started doing that. That's when they start looking like a strategic buyer, because they know, with the purchase of Virgin in Australia, they kind of know a bit about the industry.
Is that common in Australia?
It's not overly common. There are a few players in the Australian market, mostly in the mid-market, that follow that sort of pattern. So I'm just trying to think. I think it's reasonably well known that Riverside follows that type of model in Australia, at least.
And you've got to have enough resourcing to do it, I guess.
Yes, exactly. You've got to have enough resources to do it. Now, a strategic buyer might look like a financial buyer if you're a conglomerate. So someone like Wesfarmers, right? They're kind of known to buy up companies that they don't really have anything to do with at their core. So Wesfarmers initially, I mean, they're supposed to be an ag conglomerate, but I mean, they own Target, they own Kmart, they own Coles at one point, they own Bunnings, Blackwoods, Officeworks, Catch of the Day. So you'd have to argue that probably a bit more like a financial buyer rather than a strategic. All right. Let's move on. And I'm just conscious of timing. Is this helpful, or am I telling you all to suck eggs? I can speed this up a bit.
I think it's really interesting. Yeah.
All right. So types of due diligence. I'm just going to provide some examples here. So we got strategic or commercial. The term is used fairly interchangeably. So that's the market, outward looking. You know, what's the state of the industry, who are the competitors, that sort of stuff. You got the operational due diligence, which is the more inward looking. Well, the state of the assets, well, the state of the operations, supply chain, procurement, blah blah blah, contracts, that sort of stuff. HR and people. This is an important and probably increasingly important aspect, particularly from a cultural point of view. This is where a lot of integrations have fallen down in the past and continue to fall down. IT due diligence. So IT is also an increasingly important part of any enterprise. And so IT due diligence is now reasonably common. You got vendor due diligence, and I'll put that in brackets. It's kind of like, well, it's not really the opposite of strategic or commercial. It does encapsulate aspects of strategic, commercial, or operational. I've put that in there in the event of divestiture or IPO. So I've been in a situation once where we've done vendor due diligence and that information has been fed into a prospectus. So you might be called upon to do that sort of work. There's financial, which is typically the realm of your corporate finance types or investment banks, legal or regulatory. I think Nick mentioned he was involved in that. And tax. So they're just some examples. And the point here that I wanted to make is that, you know, the top 5, that's your typical management consultant scope, right? So a follow-on point from here is that there's no one framework you should be using if you're approaching an M&A case, right? You need to think through what the problem is that you're solving for and be clear on the deal thesis, right? So if I'm going to go into a case interview, I wouldn't be going in there thinking, if I'm thrown an M&A case, I'm going to throw back this particular framework. Approach it, you know, be clear on the problem, understand who the notional client is, and then think through, okay, how am I going to solve that problem? So is that clear? Does that resonate with folks here? Any
I think
questions?
so. I think
Yep.
I think it'd just be good to sort of see how some of that works out in examples. Have you got some examples of types of frameworks you might bring to bear in an M&A and due diligence?
Yep. So we'll with that we'll move on. Any other questions before we move on? Nope. Good. Okay. So one last bit on synergies. Question to the group: what types of synergies might you think might there be?
I think a lot of the things you listed last time, so operational, buying power, economies of scope, economies of scale. Yep.
So if I had to try to categorize that, I might categorize that as cost, economies of scale, that sort of thing. So if cost is a type of synergy, what might another type of synergy be then?
Revenue.
Like branding and market position.
Yeah, revenue. There's actually a third as well. So typically we'd look at cost, revenue, and capital. Now, as management consultants, we're probably mostly looking at cost and revenue. Capital, a bit less so. That's probably more so financial types that would be looking at capital type synergies. So the cost stuff, economies of scale, your purchasing power, all that sort of stuff. Revenue is cross-selling, upselling, that type of thing. Brand marketing, yes, just to a certain extent. Capital has more to do with the cost of capital. So if let's say you're a big company, you bought another big company, maybe you're depending on how you funded the acquisition, your your credit rating may go from A to AAA, as an example. I'm not saying that's the case, but that's an example, right? So then your cost of borrowing would be lower. So I've provided a bit of a framework here. This is what we used to use in McKinsey, and I'm not saying this is, the be-all and end-all. This is just an example of a synergies framework you might be looking at. So I found this quite helpful. The stuff in the light blue, that's your typical synergies that you'd be looking at. And then the dark blue is your more non-traditional stuff. So stuff that, goes well beyond your typical deal thesis. So the stuff in light blue is, in terms of your time frame, if you're looking to integration planning, the stuff in the light blue is the stuff that you do straight away, right? So that's probably within the first 12 months, right? And then the stuff in blue is a bit more transformational and it's probably a bit higher risk and a bit longer duration type stuff. So in terms of time frame, depending on how you went with the sort of core traditional synergy stuff, you're probably looking at 12 months and beyond. Now, general rule of thumb, synergies that are not captured within the first 18 to 24 months, your chances of capturing those synergies goes down significantly. So if you're doing a post-merger integration, keep that in mind. If you're doing a case interview, and I don't think I've ever seen a case interview involving post-merger integration, but let's say hypothetically you're thrown one, you'd probably want to focus in on that. Well, at least optimize for this stuff in the light blue, and then have a mind to going out to this dark blue stuff as further ideas. Okay, all clear on that?
Terry, quick question here.
Yep.
For the revenue synergies, as they ask you to do more of the quantifying of those revenue synergies, or coming up with ideas for revenue synergies, or both?
In a practical sense, so the way we would, when I say we, at McKinsey at least, for revenue synergies, you'd be coming up with the ideas initially along with the client, right? You probably run some sort of workshop to do a bit of brainstorming. Then you would have to do the financial modeling behind it, or the commercial modeling behind it. Like this stuff, you gotta have the numbers to back it up, and invariably you're delivering to some sort of target. Particularly if you're advising a publicly listed entity where they have to update the markets, right? They need to be able to tell the market, okay, so the deal is accretive. And when I say accretive, that means it's adding value to your shareholder base, as opposed to dilutive, which is taking away. If for the deal to be accretive, you need to have an idea, well, what's the quantum of accretion? Is it going to add value in terms of, 20 cents a share, $1 a share? I don't know how much it is, but you want to be able to tell that message. At the same time, depending on how they've updated the market. So, and I've seen this happen before. They've told the market, okay, the deal is accretive by 20 cents a share, and they've just counted this stuff in the light blue. The stuff in the dark blue, they've got a number to that, but they haven't advised the market. They've just gone conservative and gone, okay, we know we've got another 10 cents a share for this stuff in the light blue. We may or may not deliver on this. That's a lot harder to get. It's a lot longer duration. Cool. Alrighty. So we'll move on to the M&A sort of consulting club type slides as well. Look, kind of the message here is just tackle the case like any other case. Follow a process, solve for the right problem, pick a relevant structure. The rest of the stuff flows. I'm sure you've seen this before, so I'm not going to dwell on it. Again, the same process applies. So just follow this. Hopefully this is familiar. Tell me if it's not. Hopefully you've seen this sort of diagram before. There was a question, I think it was from Richard, about a framework. So this is a pretty good framework as an example to use in a case if you're advising a client that doesn't know anything about the market. So this is pretty good for your typical case, right? That you're going to be thrown. So if we look at the structure here, is company X in an attractive market? Okay, that's a pretty good question to be asking. How well is company X positioned relative to competitors? Does the deal provide access to strategic assets and capabilities? Is the deal NPV positive? And what is the integration plan? And does the client have capabilities to execute? So the fourth point about NPV positive, depending on how much of a hard ass your interviewer will be, they may or may not get you to do a full NPV analysis. I haven't seen an example where for this type of case, an interviewer has given you a full NPV analysis to. They just want you to do the numbers. Does it make sense to buy this or not? I haven't seen anyone make a candidate do a full DCF. Like that's just being a hard ass. I don't think it proves anything. Okay. Any questions on that stuff before we move? I think we go in an example minute. All right. So we might spend 5 or so minutes on an example. Oh, sorry. This is dot dash approach. So same structure, dot dashed, just not in our issue tree structure. All right. So case. Now I have had a case open. Just bear with me. And I'm sure some of you will have done this case before, but just for the sake of this exercise, I'm going to just walk through this anyway. Where is it? All right, so the client in this case is a company called Great Burger, and they're a fast food chain that competes head-to-head with McDonald's, Wendy's, Burger King, blah, blah, blah. They are the 4th largest food chain worldwide, measured by the number of stores in operation. So as part of their growth strategy, Great Burgers analyze some potential acquisition targets, including a company called Heavenly Donuts, and they're a growing donut producer with both a US and international store presence. So both HD and what have we got in the chat? No, I'm just reading this. So just listen in. Just listen in, because you're not going to get this script during an interview either. So listen in, take notes if you need to. So both GB and HD operate a franchise model. They also have some corporate stores. That's by the by. Okay, so that tells you a bit about their model. GB CEO has hired you guys to advise him or her whether they should acquire HD or not. So hopefully you got some notes. Not that important that you got all the detail there. So with that background there, what are some of the things that you might want to start thinking about with regard to structure? Are we clear on the problem here?
Are we just trying to work out? So we're just trying to work out if Great Burger should acquire, is it the donuts company?
Yep, exactly. That's exactly the problem at hand. So, okay, so based on that, so based on that, do you think Great Burger, well, what type of buyer are they?
Strategic.
Yep.
Strategic buyer?
Yep, agreed. Strategic buyer. Absolutely. So if they're a strategic buyer, what kind of structure do you think you might want to, well, what sort of questions might you want to answer?
Questions that come to my mind is about the store locations and how they work together. Are they going to co-locate, or is it going to be a strategy around bringing customers into the cross-selling, I guess?
Yep, absolutely. That's a really good point. So store locations, they're franchise business. So with franchise businesses, store location's kind of everything. I don't know if any of you seen the movie Founder. There's a line in there. Well, there's a part in there which says, you're not in the burger game, you're in the real estate game. I think that's true of a lot of franchise businesses. You are in the real estate game. So other aspects you want to look at?
I'm questioning just.
I'll jump in.
No, go Sam.
I was going to say, I mean, it's interesting, we talked about fast food before, and maybe you might not do market analysis, but because they are in the burger industry, I wonder if we need to understand the market for donuts, whether it be, is it a profitable kind of industry, and what's the growth projections for the donut market?
Yes, absolutely, Samuel. I agree. So yes, they're strategic buyer, but they're buying an asset that sells a different product ultimately. So I think it does make sense in this case to understand what the market is for donuts or that type food. I don't know what you're like, but I'd quite happily have a burger for lunch. I'm not sure I want to be eating donuts for lunch. That's just me. I don't know if the two are interchangeable.
Yeah. So when would you just draw a path where you're looking at strategic fit, where you question their strategy in terms of like the market? That do you think you're getting share of wallet? Are you actually going to get increase in the share of wallet?
Yep. I'd be looking at that too. Yeah, definitely. Are you going to get share of wallet? Bigger share of wallet for consumers if you start selling donuts through your channels, or vice versa. You acquire Heavenly Donuts. Are you going to start increasing Heavenly Donut share of wallet or consumer share of wallet if you start pushing burgers through their channel as well? So that's probably something you want to be looking at.
Because I was thinking, if it's a franchise, normally they do most of their stuff in-house. So how much cost economies are you going to get if the kitchens and stuff is all in-house besides supply? And then, so I'm thinking, if you go down the path and you go, it's probably not strategically aligned, do you then potentially have to go and recommend it? It's not a great strategic fit, but financially it still looks good to acquire for financial reasons?
Yeah, absolutely. So, look, any deal, be it strategic or financial, should be able to stack up financially, right? Like, regardless of who you're advising, you're gonna have to come up with some sort of model. Like, that's just what you're gonna have to do. As far as M&A cases go, expect to get a shed load of numbers and financials put in front of you. If you're actually on the job itself, expect to build an Excel model. There's kind of no stepping away from that. All right.
Harry,
So
question.
in this, yep, go ahead.
I'm curious when and if there is a discussion at all whether organic growth is relevant. Because I understand this particular question is right from the get-go, it's by a company, but maybe if their intention is to grow, they have the choice between organic growth or buying a company.
Yeah, that's a good question, Andy. In this particular case, the way that it's posed is you're kind of in phase 2 of the deal life cycle, right? So the decision's already been made that you're going to acquire. That question about should you be doing organic growth or acquisition is a good one. That's probably more in phase 1 of the deal life cycle if you're looking at the growth strategy. That's probably more a growth strategy question.
Thanks.
Yeah.
Terry, just want to ask a few quick questions.
Yep.
And I'm sorry if this has been or pointed out before. I just quickly had to duck out. But I feel that we're kind of jumping a few steps. So for me, right at the start of the case, I would have liked to ask a few clarifying questions. So for me, it feels a bit strange that a burger company is going to be buying a donut company. So my first question to whoever's in front of me would be, well, why do you want to do this? And then my second question would be, what does success actually look like?
Yep.
So from there, I can work out what type of buyer they are, whether they're a strategic company or a financial, or if it's a strategic objective or a financial objective, and then kind of make my case from that foundation. Yep.
Yeah, that's a good point, Ashwin. And I guess for the sake of this exercise, I was just trying to speed it up a bit. But absolutely, if you're going to be in the case interview itself, absolutely be asking those types of questions. All right. That comes back to the point about being clear about what the deal thesis is. So asking the question about, well, why do you want to do this? What are you hoping to get out of it? What does success look like? Yep. Those are the sorts of questions you should be asking to be clear on the deal thesis. So don't disregard undertaking that good habit when you're in the case interview in anger. Cool. All right. So I'm not going to dwell on this any further, but what you've all raised is good. Those are the sorts of questions you'd be looking to answer. And I think that's the questions you've answered gives me confidence that you'll come up with a pretty good framework to nail the case, right? So if we move on, let's say that the interviewer or your partner or your engagement manager or whoever is happy with your framework. and then you're being thrown these sorts of financials, right, and this sort of data, and this is extracted directly from the case. So if we're looking at this particular data, what can you tell me in terms of synergy opportunities?
Pulling together the corporate and admin costs, potentially?
Yep, absolutely. That's pretty low-hanging fruit. We go for that straight away. Others?
There's an opportunity to expand the donut business internationally with the burger business's footprint in places like Asia and other countries.
Totally. So that's a good revenue synergy opportunity. Thanks, Josh.
Also maybe look at like donut companies and fast food places are probably using a heap of oil and maybe some similar stuff. So you'd look at like economy of scale of dropping the cost of sales for both, because the variable costs of the oil and whatever else is in there will drop with a larger volume that they're producing or purchasing, sorry.
100%, Sandeep. Yep. So your cost of sales definitely is a good opportunity there. You know, what procurement synergies you come up with. You know, that's procurement is a very common one to be looking at outside of headcount. Others?
I'm not sure why, but the restaurant property and equipment costs are quite significantly better for the I think the crosshatch screen is covering, but I'm assuming the one on the left is of the fast food company compared to the donut company. So you probably want to look at what they're doing differently, and that should then hopefully drop the property and equipment costs as they're combined.
Yeah, totally. So that's a good point, Sandeep. You'd want to understand, well, what's GB doing to achieve, you know, much lower property costs in relation to Heavenly Donuts, in relation to sales. So there's probably a learning opportunity there. This is a good benchmarking exercise, right? So you'd definitely be looking at opportunities here. Another place you'd be looking at, so each GB store is doing $1.1 million worth of sales, and it looks to me like each Heavenly Donuts store is doing about $0.7 million worth of sales. So you'd want to understand, well, what's the difference there? Is it a difference in industry or market that they're serving? Are there opportunities there? And, you know, these are all hypotheses to look at. You'd have to source more data to understand whether these are truly synergy opportunities or not. But I think these are pretty good places to start. All right.
And so in the sales part there that you're just talking about, Terry, then is that the sort of idea of, can we push them through the same stores? So bring the donuts into the burger stores to sort of generate that revenue from a single store.
Yeah, exactly, Richard. Yep. So you want to understand whether you could do that. You know, push donuts through the burger channel or vice versa. To your earlier point about property and locations, whether or not you could close down some stores depending on how they're performing, and consolidate the number of stores as opposed to having two separate stores. So there's kind of two schools of thought with franchise businesses, right? If you're going to do that, like, it's all about the catchment. Are you going to, if you've got two stores within close proximity, are you cannibalizing the sales one store from another, or are you actually starting to saturate the area and actually increasing your overall revenue and your overall profit? You can do that from a strategic point of view. You have to do the numbers. at the same time, at least within Australia, the ACCC might have something to say about it too. This is an issue I'm currently having to deal with, where some stores, they'll have to remain open, even though it's not financially good to do so. And we have to think about, well, do we buy back the stores off the franchisees and try to shut it down? Or there's different things we're having to work through with the lawyers and work through that with the ACCC as well. But that's probably outside the realm, outside the remit of what you need to do in a case interview. That's the sort of thing you may have to worry about as a consultant once you're actually doing the job.
So,
right.
and so just a quick, more broader comment. I guess, like, if you look at this purely from an asset utilization point of view, you'd say, yeah, try and cram as many products through the one store so that you're maximizing how much you're getting out of a single asset. So that might sort of apply to other types of cases of M&A. But in this particular case, yeah, there's some other things to consider, I guess, in that, isn't it?
Oh, definitely. Yeah. M&A is fascinating. It's probably one of the few times where you get to use all of your consulting skills, right? From the strategy side to the operations, to the project management, the implementation, the HR, the IT. Like, it encompasses the entire gamut of business through the entire life cycle. And so, my hope is that you've all got some sort of interest in M&A, and you all have the opportunity to do something in M&A at some point. Because, well, I certainly find it fascinating. I'm pretty passionate about it and fired up about it, but I'm not going to bang on too much here about it.
Terry, can I just ask another quick question? So if I was going to be approaching this case, right before you showed this slide, I would probably state my 3 hypotheses. So, which would be in the realm of 1, I think that the burger business has revenue synergies, 2, has cost synergies, and 3, has a capability to inbuild in the donut company.
Yep.
And then if we're showing, this next slide, I'm just kind of wondering how we would actually drive the case forward, because showing the slide, it gives you a very top line kind of picture. And would you then maybe take a look at, well, can we fit, or to Richard's point, can we fit the donuts into the burger or into the burger shop? Can we get rid of the product and equipment? Is that where you'd probably take the case, or where would you take the case after this?
Yeah, that's a really good question, Ashwin. And thanks for sharing your hypotheses. I think my question back to you and the group would be, how might you refine those hypotheses?
Yeah.
Right.
Yeah. Yeah.
And so the reason why I asked that is, can the hypotheses be broader?
Yeah. Sure. Yeah. So I think that can be broader. I think.
Yep.
Oh, actually, no. So correct me if I'm wrong, but I've always tended to use a pretty specific hypothesis and then information.
Yeah, I'm not saying you shouldn't be specific in the wording of the hypothesis or of your hypotheses. What I'm saying is, are there broader aspects? So you've covered, there's revenue synergies, there's cost synergies, and your third one was the fit, I think it was.
Yeah, exactly.
The capability fit, right. So if I was to think about the hypotheses, I'd probably be looking at, rather than costs and revenue, because they're kind of two financial metrics, right?
Yeah.
I'd be looking at one financial hypothesis,
Oh,
a
okay.
single financial hypothesis. Then I'd be looking at a single capability hypothesis.
Yeah.
Then I'd probably be looking at a single strategic fit hypothesis.
Yeah. Okay. Sure.
And so this covers a financial hypothesis, right?
Yeah.
Then if you're going to drive the case forward, do you start looking at the capability hypothesis? Do you start looking at the strategic fit hypothesis?
Yeah. So say for example, we go through that kind of structure, and so we've focused on cost, and then we get shown this slide.
Yep.
Could you then say that from looking at this slide, simply by taking a look at the profit as a percentage of sales, that the donor company has got some significant cost synergies that we can build into our organization?
Yeah, you could do that if you're trying to drive it forward from this point and go deeper into the financial side of things. So you got your initial hypothesis on, let's say, you had the initial hypothesis on the restaurant property and equipment cost, right? So we said, we think Great Burger is doing something to drive further efficiency in property compared to Heavenly Donuts. Well, is there more data to show what's going on there? Like, are they negotiating better with their landlords? Have they picked better cheaper locations, right? You start looking at the location data. Those are the sorts of things you want to be digging into to try and drive it forward.
Yep, fair enough.
Yep.
Thanks, Terry.
That's all right. Any other questions before we move on? All right. That's kind of it for the case. It's probably taken a bit longer than I planned. So just reiterating the three things to remember, just approach this type of case like any other case that you would. Be clear on the deal thesis. And number three, which is probably the most important, always have an answer to, would you buy this company?
So Terry, you said that you don't expect these cases to go into a full DCF. Do you think that they still, like obviously in most cases they're wanting to test out your maths a bit, so they might go into some of the components of that calculation?
Yeah, they would certainly. So that particular case that I showed you, the Great Burger one, from there they went into calculating. What did they calculate? Okay, so question 3 of the case was, the team thinks that with synergies it's possible to double Heavenly Donuts' US market share in the next 5 years, and that Great Burger's access to capital would allow it to expand number of HD stores by 2.5 times. And they go on to give you donut consumption per head, blah, blah, blah. So you're kind of doing a market sizing activity. All right. So what's the size of the market in the United States for donuts? So for this sort of thing, and it's pretty common with M&A cases, invariably, if let's say you do that strategic due diligence type case, that's what's thrown at you. You have to go into assessing the competitors, assessing the market. You're probably going to do market sizing. That's typically the way those cases go. So you're probably going to have to estimate the size of the market for televisions in Australia in 2020 or something like that. It's pretty normal to do that sort of thing.
And when you say due diligence, I mean, in my mind, it sort of conjures up, someone's got a checklist of all of these things they're going to go through to check on the company. But in the reality of the case, like if they're saying, what are you going to consider in a due diligence here? Like, how do you sort of structure that conversation? Because you're kind of just thinking about what they've told you about the case. You're thinking, well, what are the key elements there? So, you know, you've sort of talked about capability and strategic. And so it's kind of coming up with a few headings that you'd sort of put them under. Is that what you'd say?
Yeah, like what kind of what I said is true about every case is different. At the same time, yeah, there's some kind of standard stuff that you would do in any case, right? So the way I typically approach it, if it's going to be strategic or commercial due diligence that the client has asked me to do, I would look at the state of the industry in its current form and where it's going. So industry, big box. Then I would look at competitors, another big box, right? Then I would look at financials of the company itself as a big box. And then I would probably look at the capabilities as another big box, right? So those big boxes, then like if I was an engagement manager, I'd have probably an associate looking at the industry itself, then another associate looking at the competitors, then I'd probably have my Excel guru looking at the financial modeling and taking all the inputs from the other work streams to feed in that financial model. And then I would feed that capabilities bit to another associate. So I'd have 3 associates and maybe a business analyst or someone like, or a grad. That's the way I'd split it up.